Good afternoon, everybody. Today is Monday, the 26th of September, 2011. This is Brian Shannon from Alpha Trends. Thanks for tuning in. On Mondays, as you know, or if you're a newer listener here, these videos are brought to you by Realtic. Realtic is a trading platform and where I do all my analysis and these charts that you find. So I do have the subscription product at alphatrends.net, but on Mondays, this video is brought to you by Realtic. So take a look at them if you're serious about your analysis of the market and interested in the types of things that I'm talking about right here. The market, I always like to say that only price pays. In fact, I think one of the best sites there is onlypricepays.com. If you go there, you'll see what I mean. But the market sometimes surprises me, and today was one of those days. I didn't think we would be able to have as big of a rally as we did have. And, my opinion got in the way of probably making some money. But the point is, I'm comfortable with that because I know what are my perceived weaknesses or when I think it's too risky to get involved. And rather than fight the market with an opinion that it shouldn't be going higher, that is trying to sell short every time it rallies here intraday, or try to get short just because it broke volume weighted average price, and stay short while the market rallies, I'd prefer to just realize that there's some days the market's just not going to work for me, where I'm going to be able to translate what I'm seeing into actual profits because my own biases. We all have biases, and half the time I say only price pays. It's because I'm reminding myself of that fact. But you can either look at the market and get in line with it and switch your mindset to what the market's telling you. Sometimes that's difficult, so the better way to handle that is to just kind of sit there and watch it with your jaw open and maybe beat yourself up and say, boy, I could have done this or could have done that. But you have to go back to realistic expectations and realize who you are and what your comfort levels are. So anyways, the market did have a nice rally today. Here we can see that it got up to an interesting number is where it closed, because it closed right on that declining 5-day moving average that I always talk about. We came close to closing this gap here. This low was 116.50. So the market is still badly damaged. We got down realistically to the bottom end of a range though, and if you're a range buyer and you're comfortable with that, then it's worked in here. But what concerns me still is that we have this weekly chart that looks so terrible, and it just seems to me as though we're going to catch another leg lower on the weekly chart. Now that's my opinion, so I'm not fighting the market with that opinion. I'd rather just let it go higher without me, see where it settles out, and then if it starts to roll over again, then get in line with that. If you're long this market, then I think that where we would expect it to go, maybe if it's going to continue, would be up maybe towards the mid end of the range, so maybe about 117.50 ish. And you can see we've got that 10 and 20-day moving average coming down towards that level as well. So perhaps that will be where we see some support found. Here's the Fibonacci off of the recent high from last week down to the lows on Friday, and you can see here that this market, or lows on Thursday rather, that this market has retraced almost 50%. 50% retracement will get up to about 116.61, and then we've got that gap closure here at 116.50 as well. So you still have to look at this with a huge eye of suspicion. We've got a declining 5-day moving average. If you day traded it well to the long side today, then congratulations. But I don't think it's the beginning of a big turnaround. It's just the evidence isn't there yet. We're still in a consolidation after the brutal decline in early August, July, August. That's what we have to look at. And typically, these consolidations are going to resolve themselves in the direction of the larger trend on the longer term time frame, which here on the weekly SPY is clearly lower. The Nasdaq was up 1.1% today, which was about half of what the S&P 500 did. Interestingly, the Nasdaq did close in the positive column year to date once again. So that, where were we at the beginning of the year? At the beginning of the year, let me see, I had that number right in front of me. The Nasdaq was at 54.46. So if we take a look at how many times we've crossed back and forth that level, We can see that, above or below that is a percentage, is whatever amount we are above or below the close from last year. That's $54.46. So we've crossed back and forth above and below that, and it really means nothing basically. We are right at the declining 50-day moving average. That will be interesting to see if it turns into resistance as it did back here. And of course, the bigger resistance, if we do get a little bit further upside, should likely come at about 55.40 to 55 and a half. That level is really kind of what this prior support was in here, and in support and resistance area. We had resistance back in here that turned into support just right in this area. So I think this is our most likely area where the Nasdaq is going to encounter some supply and begin to turn back again. The weekly time frame obviously isn't as badly damaged as the S&P 500, but if we take a look at the trend line from the lows of 2009, we've kind of been crossing back and forth above and below that, just like we have the year-to-date percentage gain or loss for the year. So I don't think that trend line really has had much value here the last several weeks. But looking at the weekly time frame or daily time frame, again, we've got a mixed message here still. There, maybe a bigger level is going to be if we break down below about 52.70. We're 2 points above that. So looking at that 30-minute time frame, maybe we rally up a little bit and begin to pull back. Now, if we do that and then the buyers regain control at about 54.40, then perhaps it's going to get the energy to push back up through the 55 and a half. Truth is, I have no clue what's going to happen here with this market. All I can do is look at what are the potential scenarios, and I think that's all any of us can do because there's been so much volatility. For anyone to say they know what's going to happen, we could gap in either direction tomorrow, and it wouldn't be a surprise to me if we gapped up 1 or 2%, or gapped up or down rather. 1 to 2%, and that part of me is expecting that. It seems like that's what we've had most often. So the Russell 2000 came down and did make a slightly lower low from the August lows. A lot of times we see a cheap new low and then a little bit of a squeeze rally. Perhaps that's what we're seeing here in the Russell 2000. We had the big heavy volume downside without further downside as the market did hold up last Thursday in that 65 level. But again, you look at the weekly chart, it's hard to make a bullish argument that this, the best argument you can make is that the market's becoming more neutral and it's finding support. To make the argument that this is the bottom is way too early and quite foolish actually. The 30-minute time frame, we're getting up to the declining 5-day moving average. We also have some prior support in here from a week and a half or so ago at 66.50. So this is, I think, going to be an important level tomorrow. Maybe we push up through that if we get a little bit higher. Maybe we get up towards this 68-ish area. I personally don't think it's likely, but the market doesn't care what I think, so we just have to look at the potential scenarios. If the Russell is going to hold on, we want to see it closing above 65.80 or so. Otherwise, back below 65.80 tomorrow, that is in particular if it gets rejected from the declining 5-day moving average, that we would think that perhaps we're headed for another leg lower. Semiconductors were up 8 pennies today, so up 0.27%. Really underperformed here again, and they've been the underperformers as we know. This 29.5 to 30 had been an important level of prior resistance and then some support, but now we're right back up to the top end of that range. That and we have this gap level as well. We've got the declining 5-day moving average, so a little bit of resistance has been forming just under 30. If we break below today's low, then I think things are going to get worse once again in the semiconductors and perhaps a move down towards the bottom end of the range near 28. The financials were up 4.5% today. So here's one group that is kind of interesting in that we've seen this happen numerous times in the financials. By that I mean we've seen a level of support and then a breakdown. Here we saw a level of support even right here and then a breakdown and a quick rally. Over here we saw this breakdown through what was an important level of support. Let me just kind of zoom in that so we can see it a little bit better by changing the scaling. But we had seen support a couple times in here, and then this breakdown. Well, from that failed move lower came a fast squeeze higher. The fast squeeze higher we didn't trust because we had that declining 50-day moving average still. And from here we had this failed breakdown as the market made a lower low just 3-4 weeks ago. And from that failed break lower, we had a fast move up beyond the recent resistance. And from that failed breakout to the upside, we had a failed break, a fast breakdown once again. So the market has finally got back down, as we know, last week below that key $12 level, and the weekly time frame still looks terrible. There's nothing bullish going on here. We've been talking about the possibility that it would be heading back towards 10.5, and that's still quite possible. But the thing is, we have this big move lower, and from this failed move, it's looking like we're getting a fast move higher. We got a lot of shorts involved in there. If you think about the supply and demand, the longs who are thinking, hey, as long as it holds above 12 bucks, I'm going to stay involved in the financials. Well, as it breaks down, they get shooken out basically, and there were a lot of short sellers looking for that to happen. They saw it break down. They didn't see a lot of further heavy downside volume in the financials, so they started to cover. So we had all this supply come out at once. We saw the shorts starting to cover, and then we saw other observers saying, the market, the financials aren't going lower right now with this bad news, so maybe I'll go in and nibble a little bit. So we had less supply because the shorts basically a lot of them kind of moved to the sidelines and said, I'm not going to add further short pressure here. I'm not going to add further supply. Then the people who were short were starting to think, hey, I'm going to start to buy a little bit back. There's a source of demand. The people who got shooken out in all their stops, well, we have that source of supply removed from the market as well, the emotional supply. Now you have the market starting to turn. Other shorts are saying, hey, get me the hell out of here. My profits are evaporating. And then sideline people in cash are looking at going, hey, there's a chance for some squeeze opportunity in these financials. So they go in and buy. So we have this complete turnaround in terms of the supply-demand equation, and we get that move back up through the $12 level. So from that failed breakdown, we're getting this fast move higher. And what's more important is to understand the psychology, just the way I kind of explained it there. Perhaps we're going to squeeze up to 13 bucks. We'd have an initial potential for resistance at 12.5, but with a declining 5-day moving average, I certainly wouldn't trust it. If we got to move lower towards 12 that held, then perhaps you start looking at the long side in these financials. But these bear markets are tricky environments to trade in. There's just the failed breakouts, failed breakdowns, and just a lot of stress to the average trader. So hopefully that stress isn't getting to you too bad, and you're doing well in this market. And that'll do it. Thanks for tuning in.